Welcome to the Rob Seco Field Ready Podcast with your host, Jim Robinson.
Hello, and welcome back to the Rob Seco Field Ready Podcast. I'm your host, Jim Robinson. 2021 is the first year in quite some time that farmers were able to forecast significant profitability. With low commodity prices and high costs in previous years, it made profit margins really thin or even negative. With many farmers finding relief this year, is it time to get serious about profitability? And how can farmers turn this year's profits into improving the long-term financial health of their farms? To talk to us about that today, we have Rob Seco's accounting manager, Jason Saalfeld. Welcome, Jason. Can you tell us a little bit about yourself first?
Thanks, Jim. Yeah, so I have a little history in tax preparation. Before I joined Rob Seco as accounting manager, my current role with Rob Seco is dealing with the financials themselves, our month-end close work, really assisting our salesmen with customer financing programs and any questions they may have. And I've been in that role now for about 5 years. Excellent.
Now, prior to joining Rob Seco, you looked at a lot of income statements, a lot of tax filings, things of that sort, as you've helped out either customers of yours or some friends who farm. So you've seen some farm income statements, balance sheets, et cetera, and you're fairly familiar with that, right?
Yeah, I really have. You see the extreme from both spectrums, the guys that are making really good decisions and turning profits, and then the opposite, where they're not making the greatest decisions and their profits are either thin or even in the red.
Mm-hmm, absolutely. So, as you think about some of those things and what you've seen and what you saw in 2021, what were the primary driving factors that improved profitability for farmers in 2021?
Yeah, I think that's fairly clear with the commodity prices, the rapid rise there. That really improved the receipts, the revenues, per se, for farmers, and the improved yields themselves. So it was a kind of a perfect storm with the yields and increased commodity prices, too.
Absolutely. And, the timing in which those commodity prices rose gave enough time for farmers to either contract bushels to be sold or actually sell them at those prices at the elevators themselves, but it wasn't so early of a commodity price rise that a lot of the inputs you would have risen too. So a lot of the farmers purchased these inputs at those lower levels and then were able to capture higher revenues against those.
Yeah, so if they were to capture those input prices last fall, prepaid for them, it really benefited their farm operation tremendously. And really the commodity prices themselves have stayed high for us. Mm-hmm. So as long as they prepaid for their inputs, captured high commodity prices, they should be doing fairly well.
Absolutely. We did see some inputs coming in a lot higher kind of in season in the spring, when people were buying crop protection products and things of that sort. But another way to word what you just said is that the fixed and variable costs stayed pretty close to the same year over year from 2020 versus 2021, whereas the overall revenue or top-line revenue increased because of the commodity prices. Now, in typical years, what are some of the biggest obstacles to sustain profitability in farming operations?
Yeah, so to sustain profitability, you really got to manage your costs. Those costs are both, like you said, your fixed and variable cost. Mm-hmm. Variable cost being your crop inputs.
So that'd be things along the lines of seed costs, the costs it takes to actually plant, so fuel and moving machinery around, fertilizer, crop protection, scouting, harvest costs, drying costs, and then finally trucking to the elevator, right?
Yeah, there's some things they control there, but a lot of times they're kind of set. As long as you can capture that stuff with prepaid and managing when you're buying and negotiating that price, but that really plays a big factor, though, in their profitability.
Now, what would be some of the fixed costs that you might run into within a farming operations? It doesn't matter how many bushels you produce overall. Those are always going to be the costs that are effectively flat across that operation.
So looking at your fixed costs, you have your salaries you pay yourself or current employees for your operation, the land costs themselves, including real estate taxes, cash rent if you don't own that ground. Mm-hmm. You have your accounting services, legal fees, other fees that you really, year over year, stay about the same.
Mm-hmm. Absolutely. And then there's also a depreciation cost in there too. I mean, there's a lot of equipment that's acquired in order to run a farm, between tractor, combine, planter, bins themselves, things of that sort. And those depreciation costs vary year to year, but within a year, that's going to be the cost whether you produce 10 million bushels or 10,000.
Yeah, there's really, coming from my tax background, there's really multiple ways that you can depreciate that asset. But when you're looking at your farm operation, you should look at that asset when you purchase it and really try to determine its useful life. So you buy a combine, it has a useful life of, let's say, 7 years. You're spreading that asset over those 7 years and looking at that 1 year and allocating that to your operation and to determine what your cost is and what kind of revenues you need to cover those costs.
Exactly. So that ultimately becomes a fixed cost within the operation. So once you know about these fixed costs and variable costs, what are some ways that farmers can look at how to budget for profitability or plan for profitability from there?
Yeah, so you take those costs, try to spread that out over the acres that you're farming, and there's kind of two methods. We kind of discussed this a little bit before the podcast, looking at your overall estimated bushel production from that farm and saying, okay, I need to here's my break even, right? And here's what kind of market price I need to cover those costs.
Yep.
My angle was you look at your acres and your cost and simply split all that cost over all your acres and saying, here's my cost per acre.
Yep.
And then you kind of look at after the fact of saying, my bushels and my market price of that commodity, this is what I need to break even and earn a profit.
Yep, and then there's some strengths and weaknesses to each of those. Budgeting based on a per bushel basis or a per acre basis. You may look at your per bushel costs, spreading your budgeted total number of bushels that you may be producing. So let's say for corn, if you allocate 60% of your revenues to corn, and you say my break-even point based on my fixed and variable cost is $3.83 a bushel, and anything above that I get in selling the grain will give me some profitability. Soybeans, that may be $10.50 with a $13 commodity price.
Agreed. And so that's that angle. And so in my mind, I was thinking that the spreading your costs over all your acres, you don't have to determine that I'm going to allocate 60% of it to corn and 40% to beans. You simply spread it out over all the acres you're farming, and then you know your cost per acre.
Absolutely. Now, once you know that cost per bushel or cost per acre, and you look at what you may forecast from a revenue standpoint, you can probably get a pretty good sense of what your issues might be, right? You might look at it and you might say that my fixed or variable costs are too high. Do I have any opportunities to reduce those, or do I have any opportunities to invest within that crop with fungicide, additional crop protection products, or whatever they may be, additional fertilizer, to increase my top-line revenue while minimally increasing variable costs to stay in the black? That would be the approach to it, right?
Agreed. You're running your farm operation like you would any business. I know farming is really a lifestyle for a lot of people, but it is a business in the end, and you really need to be cognizant of the cost. And once you do the analysis, you really can pinpoint certain items that I can save here or I can invest here and really lower my overall cost, but at the same time increasing revenues.
Absolutely. And it is really tempting to look at your revenues as something that can be greatly managed versus other aspects of the farm. You could say, hey, if I just increase my yields by 20 bushels an acre, well, you may not be able to do that. An individual field, if it yields typically 150 bushels an acre, you're not going to suddenly see 300 bushels an acre on that field. You may see 200 in a good year or under good management practices and things of that sort. But drastically increasing that, you still have to pay attention to your costs overall.
Agreed. You got to be realistic in your budgeting practices.
Absolutely. Now, land costs and overall assets and things of that sort play such a large role in a farm's financial health and profitability. What are some low-hanging fruits that farmers can address in years like 2021 where he or she might have additional income that they can invest back into the farm?
Yeah, so this is from my memory, the commodity prices, Jim, when was the last time we had a nice spike in commodity prices?
2012 or so would be the last time we had a really large commodity bump, and then kind of faded through 2014 into 15.
Yeah, so 2012, where I was preparing tax returns and helping individuals tax plan. Mm-hmm. And you had a great point, the low-hanging fruit. A lot of guys at that time look at their tax planning and need to spend money, so they're tempted to purchase new vehicles, put up a shed, whatever the equipment may be for their farming operation. That may not be the best investment to improve their operation long term. So they need to be careful.
Yeah, and so one of the things that we talked about before is one of the best ways to use that additional income within your farm is to actually pay down debt or acquire new land that can cash flow itself in order to improve your overall future profitability, because you'll have a much better debt to equity ratio, or through just stabilizing your business as a whole. So when you talk to your bank, you can weather a poor year where commodity prices may dip back down, or you may be impacted in such a way that reduces your yields overall.
Yeah, history does repeat itself. So you got to be careful. Commodity prices won't be around forever. So make decisions today that will set you up good in the future, not just to save a buck today, maybe in your tax expense. Make a decision that you would have made maybe when commodity prices were lower anyways. And again, that will benefit you long term, improve your bottom line.
Yeah, paying down debt can reduce your overall interest expenses. It can make it easier to borrow money. It can make it easier to acquire additional land in the future, whatever it might be. But also look at what among all of your investment opportunities may be, what investments have what sorts of target payback dates. So can you tell us a little bit about using target payback dates or return on investment to make these investment decisions?
Yeah, so for instance, you buy a tractor. They depreciate, let's say, over 5 years. You'd look for maybe a 2 to 3 year payback on that, depending on that expected life of the asset. And you'd look at that with any asset purchase you're making.
Absolutely. Vehicles probably depreciate much faster than they ever provide payback. I mean, you have to have a working truck in order to operate a farm, but you don't necessarily need a new truck every 2, 3, 4 years. You can probably extend out the life on those vehicles a little bit longer and get the payback. Whereas you may have larger equipment that you have some work that needs to be done on the farm, and that equipment's going to pay for itself within that 2 to 3 year period. So that's probably the best way to look at it. Field renovations are another investment that can be done well. That wouldn't necessarily be an asset that you'd purchase, although something like tiling or the land itself is an asset. If you were to tile a field, that investment can pay for itself very quickly over time, and it'll actually its lifespan is 50 to 75 years, depending on how what sort of ground you have, how well the tiling is done, how much rain, etc. So those types of infrastructure improvements can improve your operations overall, stabilize or increase your future profitability.
Yeah, there's a lot of different investments you can make. You mentioned tiling, but there's a lot of technological advances in the equipment that we have that can really provide you with a lot of data that helps you make decisions for your operation. May it be the soil moisture, what kind of yield you're getting in a particular section of the field, all sorts of things.
Absolutely. Now, Jason, you have a lot of experience with this last question here, and that is, how should a farmer prioritize investment with tax burden minimization? I mean, we hear a lot right now about farmers talking about how they reduce their tax burden for the 2021 fiscal year, whether it's prepaying for inputs or whatever it might be, but how should a farmer prioritize that, minimizing that tax burden versus investing back into their own farm?
Make sure you always consult your tax consultant, with this advice. But like Jim said, I spent quite a few years in preparing tax returns, and so I have a lot of experience with this. The tax code itself really benefits farmers. They have the flexibility to prepay in 1 year for their crop the next year and take that as a tax deduction. They are on a cash basis, not accrual basis in the accounting world. So yeah, they can prepay for their seed, for their fertilizer. They can time when they want to market their grain and take payment on that grain. when it straddles years, just to try to avoid tax.
Yeah, now that can have an impact on the following year, right? If you were to prepay for all of your inputs and hold off on selling some grain until next year, but suddenly commodity prices stay as high as they are or even go up, that could create a really difficult situation with a large tax burden the following year, right?
That could be the case. You want to be consistent year over year with what you're doing. If you're prepaying, prepay the next year. But again, my comment about marketing your grain, you do have the ability to determine when you want to sell that grain. And that if the commodity prices stay high, you may defer some of that to the following year when that commodity prices may take a downturn and you may need that income.
So what you're saying is you should really keep on top of your financials within your operation, work closely with your accountant to figure out what you may be owing for taxes, and if there are any changes you need to make to your operation in order to maximize the short and long-term profitability of your farm, right?
100% agree. You should always consult your tax professional, but decisions on prepaying and selling grain are two items that you're always going to be doing. Don't make a rash decision and buy, again, what we mentioned earlier, a large piece of equipment that you may not need just as a tax deduction.
Absolutely.
I wouldn't recommend that.
And sometimes it actually makes sense for the long-term benefit of your operation to actually incur a larger tax bill in 1 year. Maybe you have the opportunity this year to pay down a whole lot of debt that you have against your land that you purchased a couple of years ago. You can really minimize that debt that you have and put your operation in a much better position, but pay a little bit higher of a tax bill because your overall income statement is going to be high still.
Yeah, you may need that Schedule F on your tax return to look positive when purchasing a piece of ground, buying a new piece of equipment.
Absolutely. So, Jason, just to kind of summarize overall what we've talked about, 2021 could be for a lot of areas. Now, not all farmers. There are areas that were heavily impacted by drought and other events that may reduce profitability, but farmers are looking at a more profitable year in 2021 due to higher commodity prices while still having been able to pay for a lot of their inputs at the lower prices that we haven't seen, that we will see for 2022. Now, the best thing that a farmer can do with these is a year like this year is to look at their overall operation, understand where their obstacles to profitability may be, looking at their fixed and variable costs, and then to look at what are some low-hanging fruit areas that they can invest into their own farm to get a good return on investment, improve their profitability and stability over time, and then work with their financial professionals in order to plan from a tax perspective how they should either plan for those and minimize those taxes by prepaying for inputs or deferring selling grain into the next fiscal year. But overall, it may be a good thing to show some profitability so that you can invest into your own farm. Is there anything you want to add to that?
No, I think you covered it, Jim. That's exactly right.
Excellent. Well, Jason, thank you so much for joining us today on this episode.
Thank you.
As always, be sure to tune in on the 1st and 15th of every month for new episodes. And until then, stay field ready.
Thanks for tuning in to this episode of the Rob Seco Field Ready Podcast. Join us next time to be Field Ready.
A Hurrdat Media Production.